Here's something that most SMEs don't know about their corporate clients. Right now, somewhere in your largest customer's procurement team, there's a spreadsheet. And on that spreadsheet is your company name, and right beside it, it has a score. This is a dependency score. And depending on what that number is next to your company's name, that score could be the thing that protects you or the thing that quietly gets you dropped as a vendor. Procurement and risk professionals call it a supplier dependency assessment. You might hear it called the vendor concentration risk or supplier criticality assessment. It's usually embedded within a TPRM. TPRM is a third-party risk management assessment. Large corporates and increasingly mid-sized ones run structured programs to evaluate every significant supplier they have. They're not just assessing delivery times or the quality of your product or services that you're delivering. They're measuring something a little bit more strategic. The core question they're trying to answer is this: how dependent is this supplier on us for their survival? Again, they're not asking how dependent they are on you, they're asking how dependent you are on them. Most vendors have never been asked this question before, and if they have, something usually in that business relationship has already shifted. So, how do they actually measure this? The primary metric used is revenue concentration. A simple question is asked: what percentage of total revenue comes from us? That's it. And here's what the bands typically look like for a corporate risk framework. Run those numbers against your own revenue. If you have an anchor client, where do you sit? Many businesses have been growing well with a major client, and we land somewhere in the high to the extreme band, sometimes 70%, sometimes 80%. In a TPRM system, hitting that band moves you into a monetary category that shapes how your next contract renewal is handled, even before someone picks up a phone call to tell you that we're renewing your contract. Now, you might be thinking, why does my dependency on them put me at risk? Well, 4 reasons. Number 1, viability risk. If 70% of your revenue comes from one client, and by chance they happen to reduce the spend or they restructure or they switch a provider, your business is in serious trouble. Corporates know this, and they know a fragile supplier is not a reliable supplier. 2, and this one surprises most people, a power imbalance. A vendor that desperately needs your business will say yes to almost anything, and that is dangerous. They'll say yes to unfavorable payment terms, they'll say yes to scope creep, endless revisions, and procurement teams deliberately avoid becoming too dominant of a client for obvious ethical and reputational exposures that it creates. Aggressive buyers have been burned before. 3, operational resilience. If you have a dedicated staff or infrastructure or processes built entirely around one client, what happens to your operations and to theirs if the relationship breaks down? 4, regulatory compliance. Large companies nowadays run third-party risk management programs. You may have heard of TPRM. Frameworks from bodies like ISO and NIST require these businesses to run supplier, financial health, and concentration risk. The legal and audit teams have sign-off requirements on supplier classifications. So this goes far and beyond whatever relationship you've built with your contact person on a day-to-day basis. From your side of the table, high revenue from one client feels like loyalty, it feels like trust, it feels like you've earned that account. However, from their side of the table, it often looks like risk. A vendor doing 70 to 80% of revenue from one corporate client will trigger alarms in the sophisticated procurement system. Again, it's not because the work is bad, it's because the structure is fragile. It can break. Where does this surface? Number one, vendor onboarding questionnaires from new corporate clients. They will ask you about your revenue and how it's distributed. Nowadays, they also run ESG and third-party risk reviews. It's now standard for many sectors. Also supplier financial health reviews at contract renewal. Investor due diligence. If you ever seek funding, a concentrated client base is a red flag for investors too. So be aware of that. This question is also asked during pre-qualification for large tenders, especially in government and financial services. Now, what makes this uncomfortable for most vendors is that the assessment often runs without any notification, or the vendor is not actively participating in that evaluation. You might find out intent through the questionnaire, or there could be a signal in a conversation about contract terms. When those are raised and somehow it feels different from the previous years, that could be what is happening with your corporate client. So, what to do? First, you need to know your own number. Calculate what percentage of your revenue comes from the top 1 or 2 clients that you have. If it's above 50%, or you are in that territory that will raise alarms or raise flags, it's not a crisis, but it is information that you need to start managing, and start managing it now. Second, build your own narrative. If you know the questionnaire is coming, prepare a clear and confident answer about your diversification direction. Even if you're still dependent today, showing that you're actively building other revenue streams changes the conversation. Remember, procurement teams are actively assessing your trajectory. Third, do the actual work. If you're growing fast with one client, use that momentum to open other doors. Even pulling a second client to 30% of your revenue materially shifts your risk classification. You move from the extreme to maybe high, maybe medium. And that changes how your renewal conversations opens, even before someone puts in a word about price. There is a version where your corporate client surfaces the assessment and you have the conversation together. And then there's another version where they quietly reclassify you and they adjust their contingency planning. The first signal, you get a contract and the renewal feels different, but most vendors unfortunately experience the second one. At ASAP Information Services, we run these supplier dependency assessments, both from the client's and from the vendor's perspective, so that you know how your profile looks like before someone else is reading it. Whether you're mapping out your revenue concentration or you're preparing your responses to a TPRM questionnaire, or you're reviewing how your company looks like before applying for a tender. We do the intelligence work before you start that conversation. Let's talk.
bizinfo-africa, make your money grow.
See as the blessings flow.
bizinfo-africa, watch your business blow.
Oh yeah, take it to the world, let them know.
What say, check it the vision, in a bounce now.
Yeah, Bizna Boomba, we're in the house now.
From Lagos to Nairobi, we dey build the empire. My brother get the ginger, set the continent on fire. bizinfo-africa, make your money grow.
See as the blessings flow.
bizinfo-africa, watch your business blow.
Oh yeah, take it to the world, let